There's a financial storm brewing right under our noses, and it's a big one. We're talking about a nearly $1 trillion problem that could shake the very foundation of America's banking system. This isn't some distant threat. It's a ticking time bomb set to go off starting this year, and it all comes down to one thing: commercial real estate. You see, for years, developers and property owners took out massive loans to build and maintain office buildings, shopping malls, and other commercial spaces. The total, a staggering $957 billion. Now, those loans are coming due, and the world has completely changed. Think about it. How many of us are still working from home, at least part-time? How often do you order things online instead of going to a physical store? This massive shift has left countless office buildings and retail spaces sitting empty, or at least emptier than ever before. This phenomenon is often called the urban doom loop. As offices empty out, local businesses like coffee shops and lunch spots suffer, tax revenues decline, and cities become less vibrant. It's a vicious cycle. So, what happens when a landlord can't find tenants to fill their building? They can't make enough money to pay back their loans. This is where the banks come in and where the real trouble begins. It's not the giant Wall Street banks you might be thinking of. This time, the biggest risk is falling on the shoulders of over 4,000 regional and smaller community banks across the country. These are the local banks that support our small businesses and communities. These smaller banks hold a huge chunk of this commercial real estate debt. In fact, for many of them, these loans make up a significant portion of their entire portfolio. According to some reports, commercial real estate loans make up about 28% of assets at small banks, compared to just 6.5% at the bigger banks. When these loans start to default, it could trigger a wave of failures, similar to what we saw with Silicon Valley Bank, but potentially on a much larger scale. Hundreds of billions of these loans are set to mature this year and next. As property values have plummeted, many building owners are now underwater, meaning they owe more on their loan than the property is actually worth. So, they face a tough choice. Either hand the keys back to the bank and walk away, or try to refinance. But refinancing is also incredibly difficult right now. Interest rates are much higher than they were a few years ago, making new loan payments unaffordable for many. Banks are also tightening their lending standards, unwilling to take on more risk in such an uncertain market. This creates a perfect storm. Banks could be left holding the bag on billions of dollars worth of properties that are losing value by the day. This could wipe out their capital reserves, leading to instability and even collapse. If enough of these smaller banks fail, it could trigger a credit crunch, making it harder for everyone from small business owners to families looking for a mortgage to get a loan. This would slow down the entire economy. How? What can be done? Regulators are already on high alert, working with banks to manage the risks. Some are encouraging banks to work with borrowers on loan extensions or modifications rather than foreclosing immediately. There's also talk of potential government backstops if the situation gets dire. For us, it's a reminder of how interconnected our financial system is. The fate of a half-empty office building in a city miles away could have a real impact on our local economies and our own financial lives. This is a developing story, and one we'll be watching very closely. It's a complex issue with no easy answers, but understanding the risks is the first step. Thanks for watching. If you found this information valuable, please hit that like button and subscribe for more deep dives into the financial stories that matter. Stay informed and stay safe.